Every single day, businesses hand over billions of dollars worth of goods and services without receiving a single cent up front. And most of them actually expect that to work out just fine. Today we are breaking down exactly how that system works and how companies make sure they do not get burned. By the end of this video, you will understand what receivables actually are, how businesses record them, how they estimate the money they might never collect, how interest gets calculated on longer-term amounts owed, and how to read receivables on a real financial statement. Let us get into it. Section 1. What are receivables and why do they exist? Think about the last time a company sent you a bill instead of asking for payment right away. Your internet provider, your doctor, a business that invoices a client at the end of the month. That is a receivable in action. A receivable is simply money that someone owes you. From the business's perspective, it is an asset, something valuable that sits on the balance sheet until the cash actually comes in. There are two main types you need to know. First, accounts receivable. These are short-term amounts owed by customers who bought goods or services on credit. No formal written promise, just an agreement that payment is coming soon, usually within 30 to 90 days. Second, notes receivable. These are more formal. There is a written document called a promissory note where the borrower agrees to pay back the amount plus interest by a specific date. Notes are often used for larger amounts or longer time frames. Why do businesses allow this at all? Because offering credit increases sales. Customers buy more when they do not have to pay immediately. But as we will see, that convenience comes with a real cost, and that cost is the question we tackle next. Section 2. Recording accounts receivable. So how does a business actually record a sale when cash has not changed hands yet? When a company sells on credit, it records two things at once. It increases accounts receivable because money is owed to them, and it increases revenue because the sale has happened. Under accrual accounting, you record revenue when it is earned, not when the cash arrives. That is a foundational rule. Then when the customer eventually pays, the business flips it. Cash goes up, accounts receivable goes down. Simple enough. But what happens when a customer does not pay at all? That is where things get interesting, and honestly, where a lot of students get tripped up. When a company decides an account is uncollectible, they write it off. They remove it from accounts receivable. But here is the catch. If they already recorded that revenue earlier, writing it off affects the books. There are two methods for handling this. The direct write-off method removes the bad debt the moment the company knows it will not be paid. This sounds logical, but it actually violates a key accounting principle, matching revenues with the expenses connected to them. That is why most businesses use the allowance method instead, which brings us to our next section. Section 3. The allowance method and estimating bad debts. Here is something that might surprise you. Companies actually budget for the money they expect to lose. They do not wait to find out who will not pay, they estimate it in advance. The allowance method requires businesses to estimate uncollectible accounts at the end of each accounting period. They create a contra-asset account called the allowance for doubtful accounts. This account sits right next to accounts receivable on the balance sheet and reduces it down to what the company realistically expects to collect, called net realizable value. There are two popular ways to make that estimate. The first is the percentage of sales approach. The company looks at its history and says something like, about 2% of our credit sales never get paid. They apply that percentage to the current period's sales and record that amount as bad debt expense. Easy and consistent. The second method is the aging of accounts receivable. This one is more detailed. The company sorts all outstanding invoices by how old they are: current, 30 days past due, 60 days past due, over 90 days, and applies a different uncollectability percentage to each group. Older invoices are riskier, so they get a higher percentage. This method gives a more accurate snapshot of what is actually at risk. When a specific account is finally confirmed as uncollectible, the company writes it off by reducing both the allowance account and accounts receivable. Notice that this does not hit the income statement again. The expense was already estimated and recorded earlier. And here is something most people miss. If a written-off account later pays up, the company actually reverses the write-off and records the cash. The system accounts for surprises in both directions. Section 4. Notes receivable and interest calculations. Now let us level up. Not all receivables are simple invoices. Sometimes a business formally lends money or extends credit under a written note, and those notes earn interest. A note receivable has three key components: the principal, which is the original amount borrowed, the interest rate, which is usually stated as an annual percentage, and the maturity date, which is when the whole thing must be repaid. Calculating interest on a note is straightforward once you know the formula. Interest equals principal times rate times time. The time portion is expressed as a fraction of a year. So if someone owes you $10,000 at 6% interest for 90 days, you would calculate 10,000 times 0.06 times 90 over 365. That gives you about $148 in interest. When the note matures, the business collects the principal plus all the interest earned. If the note spans 2 accounting periods, the company must accrue the interest, meaning they record it as earned even before they actually receive the cash. This keeps the income statement accurate for the period in which the interest was genuinely earned. And when you start to understand how this connects to long-term lending and bonds, the picture gets even more interesting. Section 5. Analyzing receivables on financial statements. Knowing how to record receivables is one thing. Knowing how to evaluate them is what separates good analysts from great ones. The key ratio you need is the accounts receivable turnover ratio. You calculate it by dividing net credit sales by average accounts receivable. This tells you how many times in a year a company collects its outstanding receivables. A higher number means the company is collecting quickly, which is generally healthy.